Welcome back to the Dividend Diplomats channel, everybody. You got Lanny and Bert, the Dividend Diplomats. We are excited to bring you another dividend stock watchlist video.
Smash that subscribe button. Give Bert and I a nice thumbs up. It only takes a few seconds. Click the thumbs up. Get a subscription to our channel because we are on our way to 2,500 subscribers so we can bring you the WWE Dividend Smackdown Battle Royale.
We cannot wait to do this video. We have been hyping this video for quite some time, so get ready, everybody. Yeah, Lanny's getting that. We're just going to bring here. We can't wait to hear and see all of this that's going to come out of that video. I can't, and I'm going to be sitting next to Lanny during that video.
So today's video, though, Bert and I are going to talk to you about dividend stocks to buy this week as we head into the lovely Thanksgiving holiday.
Yeah, we're always on the lookout for undervalued dividend growth stocks. Yeah, we can see them. We can see a few hanging out back there behind the camera. So we're going to bring those forward in front of the camera so you can see the three companies that we are watching.
Again, there's always dividend stocks to find out there. You run them through the Dividend Diplomat stock screener that contains the three glorious dividend stock metrics of
the price to earnings ratio, less than the S&P 500, the dividend payout ratio of 60% or less, and lastly, that sweet old dividend growth history.
That's right, Bert. Those three Dividend Diplomat stock screener metrics. That's what we use to help find our dividend stocks that we want to buy each and every week.
Yeah, and for the fun of it, during the video, we'll throw in that bonus metric of the dividend yield too. Because we're dividend investors, let's be honest, we still like to look at the dividend yield. It's just not the first metric we look at.
So the stock market is still roaring. It is still pushing higher. The COVID-19 vaccine coming out from Pfizer, Moderna, Johnson & Johnson is trying to get to the finish line. All of these high success rates. The very optimistic investor right now is pushing the stock market higher and higher.
Yeah, there seems to be some light at the end of the tunnel that's coming with the vaccine news, which is fantastic news for everybody, their health, and the renewal of the economy and getting back to how things were pre-pandemic.
So what Bert and I like to do is find the undervalued dividend stock because we like to find undervaluation. We like to buy stocks when they're on sale as comparative to their competitors and comparative to the market. Because you don't want to go out there and just start buying dividend stocks that are way more overpriced than what they're actually valued at.
Now, when you're car shopping, if you don't say, hey, let me pay 10% premium on the sticker price. No, you go in the opposite direction. You want to find that deal. You want to find that great value to add to your dividend stock portfolio.
Or you just ride a bike or walk.
That is an option too.
No, but seriously, we found three dividend stocks that are showing slight signs of undervaluation in this roaring stock market. We ran them through the dividend stock screening metrics. We're here to talk to you about what they look like coming out of those and to see if they have a spot potentially in your stock portfolio.
So we're going to be watching these three stocks. So I'm sure you are all sick and tired of hearing us talk about these stocks and how we found them, and you want us to start telling you about these three dividend stocks. So what's the first stock on our list, Lanny?
The first dividend growth stock on our list comes down to the healthcare sector. We're here to talk not about Pfizer, not about Moderna, not about Johnson & Johnson, my favorite good old reliable top 5 foundation stock.
Check the video above if you want to see our other foundation stocks.
What he said.
Shameless plug.
But we are here to talk about AbbVie, ticker symbol ABBV. I know dividend investors love this stock out there. They have the very highly advertised drug of Humira, and this stock just kills it out there.
Yeah, and I'm still a little shocked that this is an undervalued dividend stock on our watch list. We're going to put up the stock price chart here and look at this. This company has just taken off in 2020. But when you really get down to it,
it's the same growth spurt that Bert still thinks he's going to try to get on.
It's going to happen. You jump from a cold 5'7" to a 6'10", and you're still.
Are you 5'7"?
I am 5'7". Yeah.
Man.
Average height. But what's nuts is you look at this stock chart, you get through it, and now we're going to show you these metrics in a second. They are still undervalued, and that is what is so exciting.
They're still undervalued because that earnings projection keeps going higher and higher for this pharmaceutical.
Yeah, that's a fantastic point, Lanny. So I think it's time to jump right into the first metric of the stock screener, that first sign of undervaluation right here. Our first metric, we look to compare the price to earnings ratio compared to the broader market, which currently has a PE ratio of in the 30s. You take AbbVie's forward earnings of $12.19 per share, and you take their share price of just over $100 per share. That gives you a PE ratio of 8.3x, significantly undervalued compared to that broader market. So as you can see, that's a huge check on right there.
Slide in the dividend payout ratio, which really talks to you about the safety of the dividend. Again, a dividend payout of 100% means they pay out all of their earnings in the form of a dividend. A dividend payout ratio of 0% means they don't pay a dividend. So we like that perfect sweet spot of 40% to 60% in the dividend payout ratio range. So we'll keep that in mind as we go through this. So AbbVie's dividend payout ratio on an annual dividend of over $5 in dividends paid per year per share equates out to a low, but in that perfect spot, of 43%.
That is phenomenal right there. That's another huge check for us as we make our way through the dividend stock screener. The third metric for AbbVie is their dividend history and their dividend growth. The company was spun off from Abbott Laboratories, who was a dividend aristocrat prior to the spinoff, and AbbVie has just increased their dividend every single year since that spinoff. So the company pre-spinoff and post-spinoff has a long-term history of increasing that dividend. But what really jumps out is the company's average dividend growth rate. Their 5-year average dividend growth rate is almost 19%. And the last piece that makes this company very cool is at the end of the month, they announced a very strong double-digit % dividend increase. They snuck it in at the end of October, and I know us and a lot of other dividend investors were very excited with the dividend news.
As a dividend investor and as somebody who wants to go to financial freedom and really live off of this dividend income stream as their main source of passive income, that dividend growth is huge. So when we saw that double-digit increase from AbbVie, oh man, I mean, it's just bittersweet, especially for this year, as dividend growth has been either hard to come by or we're starting to see the resurgence of the dividend payments. Now, last but not least, we do like to talk about the dividend yield because, again, you want to live off of this dividend income. You want this dividend income to help pay for some of your living expenses. So AbbVie gives you a nice, hot 5% plus dividend yield.
That is very strong and well above the broader market dividend yield of just under 2%. So again, they're trading at a significant discount compared to the market. They have a perfect dividend payout ratio, a strong dividend history and dividend growth rate, and lastly, a strong dividend yield. Hopefully you can see why this company made it onto our watch list.
You've hung on with us so far for this video. Time to go into dividend stock number 2. It's one of Bert's latest favorite dividend stocks that he's been buying. It's a dividend stock that you may have been buying. And this is International Business Machines, ticker symbol IBM, Big Blue.
Yeah, one of the longest tenured technology companies out there. IBM has been a part of every stage of the development of the computer and growth. The company has been in the news a lot recently as they announced their potential spin-off that's going to be happening in 2021, where they're splitting the company into two, getting rid of the old legacy business and then focusing on this new hybrid cloud business. Still with that, even with the news and some of their strong earnings results, IBM still is trading at an undervalued mark compared to the broader market. To jump into the metrics, with a forward earnings of $11.65, IBM's PE ratio at their current price is just over 10. Again, huge discount compared to the broader market.
Again, that's the price to earnings ratio. You want somewhere below the stock market, and you also want to compare them to their competitors. IBM is trading at a very low valuation multiple. Now, the fun piece now is going into the second metric of the dividend payout ratio. Similarly, you want that sweet spot of 40 to 60%, retaining enough to grow their business but paying enough cash out to satisfy those shareholders, including us. Now, IBM pays out a dividend of almost $6.50+ per share per year, and on those analyst projections of almost $12 in earnings, that leaves them in that sweet spot of 56%.
Perfect. Another company with a perfect dividend payout ratio. Exactly what we like to see here. Now, moving into the dividend growth history, IBM joined the exclusive Dividend Aristocrat Club earlier in the year when they announced their 25th consecutive annual dividend increase. As a reminder, a Dividend Aristocrat is a company that has increased their dividend for 25 consecutive years. So that shows that a company has increased their dividend through the dot-com bubble, the great financial crisis, and the pandemic at a minimum. So IBM, a technology company, increasing their dividend through each one of those big bubbles and economic downturns is a huge sign and a huge testament to the company's long-term dividend growth history.
They made it into the club. They got the access. They're in the Aristocrat Club.
Yeah, welcome IBM. We're excited to have you in our portfolios and to see you sitting at that table.
Now, I've said it before, though, they barely got there with a 0.25% dividend increase this year during the pandemic. Let's just say that I can't take any more of those small dividend increases.
No, that was at the beginning of the pandemic, but now that dividend increases are back, we'll see what 2021 brings when they announce that 26th consecutive annual dividend increase.
So then you want to know about the yield. You want to know about the income that IBM can pay you. And similar to AbbVie stock, if you buy IBM stock, that's going to pay you a dividend of almost 6%, at about 5.6% at current prices as of November 20th. So they are going to be paying you far more than what your savings account will, and about 3 times what the S&P 500 is currently yielding.
Yeah, so similar to AbbVie, hopefully you can see why we're liking IBM today. Their PE ratio is very low again, perfect dividend payout ratio. They're a dividend aristocrat with a strong dividend growth track record and a very sweet dividend yield of over 5%.
Now, we're here to talk to you about the third company on the dividend stock list to buy this week heading into Thanksgiving. And it's weird. It's a company you've seen when you're driving. It's a company that you've seen on boxes. Mm-hmm. And it's also a company that also transforms into a very securitized digital landscape due to the pandemic even more. That company is a mountain that Bert's about to scale.
It's not made of copper. It's not made of gold.
It's not made of tin.
No, it's not made of aluminum.
It's Iron Mountain.
Ticker symbol IRM. We love this company for all the reasons that Lanny described below. I know when I used to work for a large corporation several years ago, in that very short stint there, it was Iron Mountain boxes were everywhere as they took a ton of paper and were moving it constantly.
So they are a REIT, a real estate investment trust, which, has us looking at the Dividend Diplomat stock screener a little bit differently, because really, instead of earnings, you want to focus on adjusted funds from operations. That's really the key metric, and you use that as a multiple of how they're trading in comparison to the AFFO. And as a REIT, they are required to pay a significant amount of dividends to you. So naturally, you're going to anticipate and expect a higher dividend yield. And then lastly, with the REIT, you're actually taxed, if you have it in your taxable brokerage account, at your ordinary income rate and not at a qualified dividend income rate.
Thank you for pointing that out, Lanny, because it's a very important thing we need to point out, because if you take price to earnings and divide it by earnings per share, that is not the proper way to evaluate a REIT when you're looking at their metrics. So again, instead of EPS, you're going to be using funds from operations, or FFO. Huge distinction here, and especially as we start running through the metrics.
So Bert, what's the Dividend Diplomat stock screener metric number 1 for the AFFO?
Yeah, so their annualized FFO from their previous earnings release gives them $2.31 per share. So that price to FFO is 11.1, or just over 11.
So they're trading at 11 times their operational performance, which is still showing signs of undervaluation in comparison to the market. Now, and again, we're using their prior performance and annualizing that out, but one would actually think that after the last 8 months of the pandemic, performance is going to be better. So this is a very conservative approach that Bert and I are taking with Iron Mountain.
very conservative to say the least. So as we move into that second metric, the dividend payout ratio will compare their annual dividend to that FFO number of $2.31 that we use.
And this is the scary metric that you may see, and it will give you a little bit of a shake if you're watching this video.
Yeah, so with their quarterly dividend of 61.9, you annualize that, divided by the $2.31 per share, so that gives you a payout ratio of 107%.
Yeah, not what we want to see, but again, a very conservative approach to seeing how much in dividends are they paying out. Really they're at that top ceiling of a ratio that I would ever want to see. But again, this is a very conservative, I think almost worst case right now for Iron Mountain. And I anticipate the fourth quarter is going to be better.
Yeah, and what makes sense for Iron Mountain is they were supposed to increase their dividend at the end of October. That's their annual timing. Mm-hmm. They did not increase their dividend. They didn't cut their dividend. They didn't suspend their dividend. So management's comfortable with their current cash flows at that ratio, but there obviously is not a lot of room to increase their dividend. So companies stayed put. This will be something to keep an eye on going forward and see if hopefully things are as optimistic as the picture Lanny is painting, so that the company can continue increasing their dividend in the future.
From a technical standpoint, they'll still classify this as a dividend increase year because their dividends they paid in 2020 were greater than their dividends paid in 2019.
You gotta love some of these technicalities because they have increased their dividend, that is for certain. But when you peel it back, you're not seeing the annual dividend increase that you would normally expect.
So we just went over the price to AFFO ratio, the dividend payout ratio, dividend growth. The reason why it's still on the watch list is because you don't necessarily need the growth right now with Iron Mountain. Because their share price has gone south, this has increased that current dividend yield.
And it is a juicy dividend yield indeed. At their current share price with their current dividend, it is nearly 10%. It is 9.6 at its current level, so an almost double-digit dividend.
And typically, we don't promote or even recommend looking into companies with an extremely high dividend yield. I mean, oil has been there earlier this year, which now that yield has come down to an increase in their stock price. Similar with Iron Mountain, they usually don't yield this high. So we are kind of looking at this as an accidental high yielder from the words of Jim Cramer.
Yeah, and I think that's a great point of distinction here because, again, we've looked at the payout ratio before we looked at the dividend yield, and we're comfortable with their current payout ratio at this moment, even though it's higher. So therefore, we're comfortable looking at the higher dividend yield accordingly.
So one thing to consider if you are looking at a REIT or high yield company such as Iron Mountain is if you put that into a retirement-based account so you don't have to pay that current tax on that high dividend payment you are receiving.
And that's where I hold Iron Mountain in my portfolio.
Me too.
So to summarize, we've gone through 3 dividend stocks that we're going to be watching as we feast on some turkey, some stuffing, some mashed potatoes, and some green beans. Those 3 companies, AbbVie, IBM, and Iron Mountain, all showing signs of undervaluation and performed very well in our Dividend Diplomats dividend stock screener.
So that's 3 dividend stocks that you can consider buying leading into Thanksgiving. Again, we hope that you also perform your own research on these 3 companies. This is just, a list that Bert and I were able to put together running through our stock metrics as we look for, adding dividend income on our journey to financial freedom. And hopefully we're helping you on that financial journey that you're on.
Yeah, so tell us 3 stocks that you're watching during this week and if you agree with ours or if you disagree. And if not, what differences do you have and why? We're excited to hear.
Don't forget to like the video, subscribe to our channel. In case we don't hear more from you, we wish you a happy Thanksgiving. This is Bert and Laney from the Dividend Diplomats.
Over and out.